I'm Megan Trask, Director of the Investment Committee here at CTWM. I am joined by my colleague and Assistant Director, John Shanley. We are here mid-July 2022 and coming to you with the quarterly update from our Investment Committee. So I think we'll just dive right in. John, do you want to give us the lay of the land, where we stand year to date with fixed income and equity markets?
Absolutely, Megan. So there's really no way around it. Q2 was a challenging quarter for equity markets and bond markets to follow along with a challenging year overall. Right now, as we sit here, the stock market's down about 20% on a global basis, and the bond market's down about 10%. So there's been really no place to hide in the broad sense of portfolios. On the stock market perspective, 20% in a short period of time has been challenging. But what's kind of interesting, especially as we talk about bonds here in a second, is that the 20% down that we've seen is probably not all that out of the range of outcomes that we expect. Right? We tend to see bear markets like this from time to time. Doesn't make it any easier to live through, but we understand as investors that these types of environments will happen. What's been unique and challenging, to put it bluntly, has been the fixed income environment. We talked about it in one of the last videos we did, but this has been one of the worst starts ever for fixed income markets, down 10%. We've talked about what that means for the future and some of the attractive levels of interest that we can get going forward, but we just want to always acknowledge the fact that we sit here today and portfolios haven't done exactly what we would expect them to do over any type of environment.
Yeah, and I think that sets the stage for the goal of our talk today, which is to really reinforce three principles that we've talked about earlier in the year. Not a ton has changed, unfortunately, from our last quarterly update in terms of it still being a challenging market environment. So I think the things that we're going to talk about today, we just can't emphasize enough. And maybe we can boil it down to three notions to keep in mind, again, as we still sit here in a down market. And maybe we'll just jump right in. The first notion that I may hopefully give you some added perspective of looking at your account statements right now and performance is really to keep the long-term perspective of performance. As John just referenced, the stock market is down 20%. So large cap blend stocks are down 20% year to date. The 10-year annualized returns of large cap stocks is still 11% as we sit here in a 20% decline. We can't forget that we have had really strong returns over the last couple of years, and while we sort of readjust to those new account values that we got used to seeing in December 2021, and it makes it really challenging to kind of reorient yourself with new declining account values today in 2022, it's so important to keep that long-term perspective and expectations around returns. So, even for our balanced investors, which most of our clients are balanced, invested in stocks and bonds, returns in that 4 to 6% range is what we're seeing across portfolios. That lines up with our long-term planning assumptions. That lines up with our return expectations. We've got to remember that we don't experience returns in a linear fashion. It's, the price of growth is volatility, and that's what we continue to experience this year.
That's so well said, Megan, too. And markets have this kind of self-reinforcing mechanism where when prices go down, it's never fun to live through, but that means our future expectations go higher, right? And there's that old Warren Buffett saying that you should treat stocks like socks. You want to buy things when they're on sale. Yeah. And it's the same general idea with the stock market. Again, that doesn't make this experience an easy experience to live through, but it's also part of what we kind of expect on a long-term perspective as investors.
Well said.
I think the next one, and the next item that definitely comes up in the news a lot, and I have a sense that we might hear more and more about it, is the idea of a recession. And as you know us, we're not here to predict when a recession is going to happen or if it's going to happen, but we do think some context around what recessions mean for investors is important. First, and we'll keep this relatively high level, but I think we're going to hear a lot of news about it, is what is a recession? A lot of us have heard that a recession is 2 quarters of negative GDP growth. Mm-hmm. It's kind of what we've learned over the years. And theoretically, Q1 was a negative GDP growth, and then Q2, we're unsure, but there was a chance that could be a negative GDP growth. So theoretically, we could be within a recession as we sit here today. So what does all of that mean for investors? Well, I kind of said it in what I just mentioned there, is that means that we are in a recession right now. That doesn't mean we're going to be in a recession for the next quarter or the quarter after. And as we've alluded to in the past, the stock market is all about future expectations. It doesn't really matter what happened yesterday. Maybe argue it doesn't matter what's happening right now. It's all about what's going to happen into the future. So, again, we're not going to try to predict when a recession is going to happen, but if we're in one right now and that's what's in the news, that means most likely the stock market and the economy is looking forward. It's looking for that next opportunity. And you could say this about a lot of different environments, but historically, when you're in the recession, future returns on stocks actually look pretty attractive, right? You want to stay invested through these type of recessionary time periods.
Yeah, I think the last point you mentioned about recessions is that they are a normal part of full market cycles. And while that, again, doesn't make it easier, especially if it ends up coming with, job losses and other kind of impacts that all of us would feel more, doesn't make it easier. It is a part of functioning and healthy economies. And so I think that kind of leads us into the third notion that we would reinforce today, which is it is just impossible to time these things. And the reason you really don't want to time them is because, just as John mentioned, return expectations coming out of bear markets, coming out of recessions, actually go up. There's 90 years of data to show us that returns can be really, really strong coming out of a recession. And it can happen really quickly. And if you miss just a couple of those up days in the market, it can have pretty catastrophic impacts on your long-term returns. So while it probably goes against every fiber of all of our beings to not make some significant changes in the portfolio, it's often exactly the right thing to do. Because it's just so impossible to time these things. Keeping your balance, having a plan ahead of time is really key to weathering these types of environments.
And Megan, that's such an important point, but it's also what makes investing so challenging at times. I think our nature is to say, I'm just going to wait until the coast clears. But usually by the time the coast is clear, a lot of those returns have already happened, because usually the best returns and the best days tend to happen at the bottom of the stock market. So trying to time it and trying to get in and get out at the exact right time to us is an impossible game to play with any degree of accuracy.
Yeah, well said. So I don't think we broke any news today, and it's probably nothing you haven't heard before, but these are the most important principles of portfolio construction and investing, and given such a challenging market, we felt worthwhile repeating. As always, we thank you for your trust and your friendship, and don't hesitate to reach out if you have questions. Take care, everybody.
Take care.